Hi, welcome to the FANG. This is Doug Zucker. I'm the FANG Banking SIG chair. We have a number of other FANG groups here. We have folks from around the country joining us, and it is my pleasure to introduce Mel Brue, who's Senior Analyst at Moor Insights and Strategies and Forbes contributor. Along with Mel, we have Orlando Zayas, who's the CEO of Catapult, an award-winning omnichannel payment platform. As you know, this is going to be about BNPL, buy now, pay later. And it is my pleasure to introduce Mel Brue and Orlando Zayas. Take it away.
Thanks, Doug.
Hi, thanks. Thanks for having us. As Doug said, I am Mel Brue. I'm Senior Analyst at Moor Insights and Strategy. We are an analyst firm based in Austin, Texas. Fun to hear where everybody else is from. We are an analyst firm. We study, advise, consult, and communicate our clients' products, market position, and value. And that is how I actually came across Orlando and Catapult. As Doug also mentioned, I'm a contributor to Forbes and taking a look at the buy now, pay later industry. And when a firm did their IPO and it did a pretty nice showing in their IPO, it struck me that it was something that was definitely worth taking a look at, and wrote about what was happening in the industry, particularly with the shopping habits that were happening during the pandemic, and then came across Catapult and got to know Catapult and Orlando, and saw that it was really a different product offering than what we're seeing from Klarna and Afterpay and Affirm and some of the others. And I'll let Orlando explain some of that. But when Doug then reached out to me, I think after having read that Forbes article and asked if I wanted to speak on this, I thought it would be interesting, more interesting than y'all just hearing straight from me talk for like an hour straight, which I don't think anybody wants to do. I asked Orlando if he wanted to participate with me. And so maybe different than kind of some of the presentations that you're used to seeing, I wanted to do this more the way that I typically do an analyst briefing, which is, and Doug, you're frozen, so I'm not sure if I am.
You're not.
Are you hearing me okay?
Yeah, we can hear you. Okay,
good. Okay. Anyway, just to kind of set the stage, we do have, and actually I'm going to share my screen just for a second. There we go. Well, first I'll go back to this one just for the introduction. The agenda here after intro. So just the topics that we'll share, but just to kind of set the stage of how we'll kind of go through the discussion here will be very similar to the way that I typically do a briefing. And that's kind of how I gather information on any industry topic. And we'll this is sort of a hybrid between a presentation and a briefing. And so what that will mean is that we'll go through these topics. And again, as Doug said, feel free to pepper us with questions at any point. We'll have a Q&A at the end, but if you have questions on any of the topics that we're talking about, put them in and we'll either, say we'll address that later, or we can talk about it at that given time. But the way that typically, I like to gather information with briefings is to kind of see where we're at in the industry, talk about what we're seeing in the industry, and then ask specific questions from an expert like Orlando. What are they seeing? What's he coming across? And something that's really interesting with what's happening with Orlando and Catapult is that they're taking their company public through a SPAC right now. And although off topic somewhat on what we're discussing today with buy now, pay later, it's definitely a hot topic, for all of us. And I recently left what my most recent position was CMO of lottery.com, which is also going through a SPAC. So if we have time, we might just do a little off-topic SPAC discussion as well. If anybody has questions or any insights on that, I think that could lead to an interesting discussion too. So at that, I will pass it off to Orlando to make his introduction, and then we'll just get into talking about the industry.
Hi, everyone. Orlando Zayas. I'm the CEO of Catapult. I've been with Catapult since 2017, and what struck me when the board brought me in about the business was that it was helping non-prime consumers access durable goods. So that's refrigerators, appliances, the things that they need for everyday living. And so we partnered with many large e-commerce retailers like Wayfair and Lenovo to offer a seamless way for the consumer who was rejected for prime lending to transact and get the items they need. So for example, and when you're looking at you need a couch because your couch is worn out, we can help that non-prime consumer, get the items they need at quality retailers and a reasonable price. And we work very closely with them because a non-prime consumer, is a little different. We have to work closely with them on their payments. And one of the topics we were going to talk about is returns. The customer can return the item at any time. And we use the lease to own mechanism as a way for that customer to acquire the goods. But the beauty of that is that they can return the item at any time and discharge the debt, unlike maybe an installment loan or credit card. So we've grown the business quite a bit since 2017. 2017, we did when I joined, about 17 million in revenue. Last year, right before we went public, or did the SPAC transaction, we ended the year about 250. So in 3 years, we grew pretty dramatically. And that growth continues. And I think the reason it does is because, buy now, pay later is exploding. And we can talk a little bit about the insights on buy now, pay later. But I think what's happened is the non-prime consumer is kind of left behind. They don't have access to split the payments over 4. They don't have access to get prime lending. So we help fit that bill and get the customer the items that they need. So we've grown the business pretty dramatically. This year, we're planning to do over 400 million. And we just completed haven't completed it, but we're in the process of completing the SPAC transaction, and our de-SPACing will happen in June next month. So I'm pretty excited to be in New York City ringing that bell when we go public with KPLT as our ticker symbol. Will be our ticker symbol. We are based officially out of Plano, Texas, but we also have an office in New York. I'm currently in New York. I flew in. I actually live in Austin, but we've been able to grow this business and manage it all from home, including our call center and our chat group. The team is pretty excited about our next steps and providing these consumers with clarity and transparency around getting the items that they need. And that's where we focus. Mel?
Yeah. So just to kind of set the stage of where the industry is, there was $24 billion in spending in 2020 in the US alone. Industry-wide, it is expected to reach $347 billion globally by 2025. So this is a massive industry. During the pandemic, just in that fiscal year, spending was up, revenue was up for most of the buy now, pay later companies, up to 98%. And for some of those companies, like a firm that had their IPO and that was pretty big showing, their stock is actually down a bit now. We can talk about that later when we talk about some of their acquisitions and things that they've done since then. 30% of their sales was from Pelotons. So if you take a look at kind of what was happening during the pandemic, what people were buying, not just that people were staying home and that they were, most people were forced to start to buy online, but they were buying online. Everybody was shopping online. We were all forced to shop online, but they were buying really high ticket items. So this was a time when people needed big ticket items or decided to buy big ticket items, weren't able to go to the gym. Obviously, Peloton answered to that because a lot of people were buying, expensive gym equipment. But even just for regular kind of everyday purchases, the uncertainty of people's paychecks obviously caused them to look to this as an answer for ways to purchase things that they were, sort of uncertain of what next purchases they could make. I think, I know some people who maybe wouldn't have considered buying in installments, maybe don't want to use a credit card during that time. And obviously millennials are less inclined to use credit and many of them don't even carry credit cards. So buy now, pay later became such a important option during that time. Orlando recently shared something with me that I think was really, really interesting. What was your biggest day last year of sales?
April 15th, which you would just be shocked that that would be our biggest day, but that's when the stimulus hit. So when the stimulus hit, people felt more comfortable buying online, but also buying on payments, buy now, pay later, because I think they felt comfortable that they had the cash coming in that they could buy more.
You're trying to do some things, you're muted.
Now she froze.
Oh, okay. It looks like she was trying to say something, but she's muted. If you are trying, Joyce, we can't hear you. Okay. I saw you do that, but okay. Yeah, okay. So then I think, what we're seeing now is a return to somewhat normal for most people. I mean, certainly here in Texas, people are now up and vaccinated and out shopping, but the trend is not as drastic as expected, that people don't necessarily want to go back to stores, that the shopping online has continued. Stores are not as stocked, as plentiful as we thought. The buy now, pay later trend is continuing. People are continuing to want this as an option. Definitely, we're going to see, I think, less of Peloton sales. We're going to see people wanting to travel, and they're going to want options of how are they going to pay for travel and other expenditures that maybe aren't yet covered by payments quite yet. What do you think is going to happen when people decide that they want to go back to stores? Or actually, I think they're not going to all decide that they want to go back to stores, but how are you addressing it, and what are you seeing? Are you seeing the same thing, in general in the industry?
Yeah, surprisingly, and I think a lot of people have surmised that people would just stop buying online and go back in the stores, and we don't see it happening on our side. As a matter of fact, the consistency of e-commerce sales has continued. And I did read one analyst that said that what the pandemic did for e-commerce is just moved it ahead 10 years. And I gave Mel an example of myself. I saw this really cool refrigerator that made round ice, and for you brandy or whiskey drinkers, having one block of round ice is a great thing to have. And it was a dual ice maker. I bought it online, never saw it, never looked at it. They had it delivered. And so I think what happens is the consumer has now realized that it is easy to buy online, and they're buying online. But I think what they're also realizing, and I've witnessed this myself, is when you go into the stores just don't have their inventory, right? They're not spending the money on having a lot of inventory because so many people have purchased online that, you go in the store, you may see, a black pair of jeans, but you wanted blue. Well, they'll order it online for you and ship it to your house for free. So, the trend continues. We deal with over 150 different e-commerce retailers. We have not seen a shift. The trend continues. People are continuing to buy. I mean, one of the biggest products that we have retailers is the mattress in a box. And if you would ask me 10 years ago, would I buy a mattress online? No, I want to lay on it first. But surprisingly, that's one of our biggest retailers and really biggest channels is the mattress in a box. And they continue, and people are continuing to buy those things. I think the millennials for sure are driven towards e-commerce, but I think what the pandemic did is it forced people to use e-commerce, and now they're comfortable with it instead of being fearful that they're going to get something that they can't return.
Yeah, well, first of all, it not only forced people to shop online, but it also forced companies to advance their technology. We call this sort of like a forced compression. The technology companies, and especially retailers, had to take like years of advancement of technology and compress it into months. And so the things that we've always wanted, from online shopping and from checkout that we didn't have, that, made online shopping sometimes cumbersome and frustrating. These technology companies were actually forced to make these integrations happen so quickly that things are actually really pleasant and easy to shop online. Checkout is easier. Everything that, the whole process is just easier now. And even inventory, everything from supply chain to checkout is a lot easier on the consumer. So that's another reason why I think people are going to continue to shop from home.
Yeah, I have a funny story about that, Mel. There was at the beginning of the pandemic, one of Wayfair's competitors, let's just say, a big European box store who shall remain unmentioned, actually reached out to us because they saw what we were doing with Wayfair. They wanted to tap this market of the non-prime consumer. And when we presented our product offering to them and talked about the integration and such, they said, we love it, but I've got 10 other projects I got to get done, because they really weren't that good in e-commerce. And so they realized that they needed to get good in e-commerce first before they were going to add other financing options to their site. And we've seen that. I've seen that from a few big retailers that you would think would have a good a good online presence. They're really having to invest, and they're having to figure it out because the shopper isn't going away. And I use this comparison with Amazon and Walmart. Walmart, they love to brag about how good they are in e-commerce, but they're never going to be Amazon. And Amazon has invested in the e-commerce consumer. They've obviously how they track packages and ship packages. And that's something that they've learned and they got really good at. And so some of these brick and mortar retailers are really going to struggle, I think, and they have to invest in the technology. They have to invest in logistics and getting stuff out to them, like Wayfair has done, like Amazon has done, if they want to compete.
Mm-hmm. Yeah. I think now when we'll see, some of these things were so compressed and so rushed that now, we used to talk a lot about, like surprise and delight. And that actually turns out it's not that important. It's about like getting the product done and done right. And then you can add the bells and whistles. Nobody really cares if you get confetti when your package arrives. Amazon doesn't do that. Amazon built it as, let's get this done and get it done right. Your package arrives on time, you know where it is, you can track it, and you get the right thing every time, right? So they built it that way. I just wrote about them just recently. They built it that way, and they are the platform to do that. Now they can add all of these ancillary products and bells and whistles to it, because they've already built that platform to get it right. Yeah, and by the way, I love my bed in the box. I have a Lisa mattress. I swear by that thing. So if anybody needs a bed in the box, Lisa is like it's the bomb. They're not a client. I don't work for them, but they're just amazing. Well, okay, so you have talked a little bit about the subprime market, and I think that deserves a little bit of explaining, and kind of merges into our next topic, which is why buy now, pay later isn't for everyone. And just before we get to that, I kind of want to talk about some of the critics of buy now, pay later. Certainly we'll talk about how people could be spending money they don't have, and that's certainly a risk. There have been comparisons to payday loans. I say that's not even close. Payday loans are absolutely predatory, and the amount of money that you pay compared to what you borrow is just heinous. I think for a responsible buyer, and if you read the terms and conditions and you know what you're getting into, this is a very good alternative to a credit card. I think people do obviously need to take a look at what the impacts are on their credit, not necessarily the bad impacts on their credit, but what their lack of building credit. If it's somebody like a young person who is trying to one day save for a house and needs some credit history, the fact that these companies don't report to the credit bureaus, something we can actually get into talking about later. Ironically, Orlando and I were at at a restaurant in Austin together last week and had a conversation with one of the VP of sales at Experian about how this is a real big problem that needs to be solved, that the credit bureaus need to figure out a way. Well, the buy now, pay later companies and the credit bureaus together need to figure out a way that we can somehow positively impact these consumers who are repaying on their purchases responsibly and should have some sort of reward to their credit history for doing so. But we talked about subprime buyers, why buy now pay later isn't for everyone. Can you talk a little bit about what happens when somebody applies for a purchase through, say, a firm or another and they get declined? Where do they go from there?
Yeah, no. So one of the things that e-commerce retailers have realized is that when a consumer needs financing, and I've got a stat here that we've used, 48% of U.S. consumers need financing for a purchase of $400 or more. I mean, that's a big number of the population. And so when they're searching for financing, they're doing it online. If they apply for a firm or Synchrony or any of the banks and they're turned down, what happens, and we have the data to support this, is they disappear. And I think probably everybody on this call has been on a website and you abandoned your cart for whatever reason. And then all of a sudden you're getting messages say, hey, you left a cart open, you left a cart open. And what the retailers realize is that customer, when they're shopping, it's just like being in a store. If they leave the store, they're probably not coming back. So how do you capture that consumer? And so what we've done is we've actually created a waterfall with many retailers, and Affirm was our first partner. So if you're on, for example, Purple Mattress, another good, not Lisa, but another good mattress in a box, and one of my clients, and you apply for Affirm, if Affirm was going to turn you down, your data would come to me automatically, and within 5 seconds, less than 5 seconds actually, I'll return back either an approval or a decline. And we approve somewhere between 60–70% online because our models have gotten that good. And so we're able to capture an incremental consumer for that retailer. And then we're also able to provide that consumer who is looking for that good, the durable good, whether it's mattress or whatever, a way to pay. And they can check out within 90 seconds. And so that's one of the things you talked about, Mel, about that kind of technology that the retailers have to have. One of the things they demand and we provide is that speed. And the less than 5 seconds, the less than 90 seconds to get the transaction completed, and we're shipping the item almost once they're done with the transaction online, and we capture that consumer at the time. And it's really important for the retailer, but it's also important for that consumer, because again, they're going to leave, they're going to go somewhere else. They may go get a payday loan because they don't have any other option to buy the goods that they need. So I think we're helping them get the items that they need. We bring an incremental customer to the retailer, and it's a win-win for both. But I think the thing that's really interesting is that if you look at the consumer's behavior online versus in store, you're taking the element of the salesperson out, right? And we've all been in that store where the salesperson is like, no, you need coffee tables to go with that couch you bought. Oh, you need a recliner to go with it. And you walked in maybe wanting to buy a sofa, and you're walking out with a lot more stuff. And so what we find online, which I think is incredibly interesting, is that the consumers are actually pretty responsible, and they only take on the debt that they can afford. And we see it in the average order. So for example, just to give you a couple metrics, our average approval is between $1,500 and $1,700, but our average transaction is only around $600. And so they're not, being strong-armed by a salesperson. You can picture the story. If you're in a store and you apply for financing, and the salesperson comes back all excited and proud, is you got approved for $2,000, and you wanted to buy a $600 sofa, but guess what? You're probably walking out with $2,000 worth of stuff that you can't afford. And so, I think providing this to those consumers, especially when they're on a tight budget, that they're actually pretty responsible. And it was enlightening over the last 4 years of running this business to see that as we've launched with other retailers, that The consumer just doesn't go on a spending spree just because they're approved.
Yeah, I think that's really interesting. I think it puts a lot of power in the consumer's hand to buy responsibly without that pressure. And, you know, again, another reason why there may be less, but, you know, less return to in stores. We do have a couple of questions in the chat, and one of them is actually related to a question I was going to ask you. There is one question I wrote down because I want to talk about it a little bit in a little bit, but with so many players in the market right now, what's the outlook on the industry in 12 to 24 months? We'll get to that. There was another question that was a direct message, which I answered, but maybe because there were people who joined a little bit late, a quick re-intro. I'm Mel Brue. I'm Senior FinTech Analyst at Moor Insights and Strategy. Orlando, you want to do a quick, quick
Orlando
intro?
Zayas, the CEO of Catapult. We provide point of sale financing for durable goods for the non-prime consumer.
Okay, then the other question we just had was how much data do you need to make that approval decision? So I think that's related to a question I was just going to ask you because you talked about how quickly you can make a decision. I sort of know the answer because we've talked about this, but I think it's an important one to talk about, and also bringing into account the purchase that's being made. We've talked about in the past that there's a difference when somebody wants to buy, you know, a couple $100s worth of makeup or a handbag versus if they need a refrigerator or new tires. So do you want to just talk about your data?
Yeah, we only require 7 pieces of data. And it's what you know. It's the last 4 digits of your social, it's your name, address, and your phone number. We always start with the phone number. And it's amazing how much information we can get. We take those 7 pieces of data, I can get 100 different attributes and then 2,000 pieces of data on that consumer. And that's what creates our model. And so then our model helps us predict, is that customer going to pay us back or not? The other thing we add into this is the type of product, because appliances, for example, the payback is really, really strong. Electronics are a little less strong. Because, I always say want versus need. You need a refrigerator. If your refrigerator breaks down, you need it today. You don't necessarily need a 65-inch TV unless it's Super Bowl. So, and the payback really kind of shows in that. But, we use machine learning and AI to improve our models, and we continue to improve our models, and our approval rates continue to go up. And I think I said we return the approval back to the consumer in less than 5 seconds. So it happens almost instantaneously. And that was one of our retailers early on said, it's got to be fast because nobody wants to sit there watching the hourglass spin. 30 seconds is an eternity when you're waiting to see if you got approved or not.
So there's another question, since this type of lending is not on a credit report, how do you determine if someone has multiple loans each through different providers? Just industry-wide, I'll answer that first, and then Orlando can answer that. Industry-wide, it's somewhat standard that a soft credit check is done. So if people have defaulted on from different providers, they will find that out during that soft check. So they will report on bad credit, they won't on repayment. If somebody is repaying and they want to have multiple loans, then they're repaying it responsibly, then I don't think that it actually matters.
Yeah, I can add to that, Mel. I mean, I think what we see online is that piece of data isn't that important because we can kind of see whether they've missed payments and stuff from other providers. Because online, again, as I've noted, the consumer is actually pretty responsible, and we have a really strong fraud tool. So if somebody's just going around trying to apply, we'd actually see that and probably reject them.
Okay, there's one question that was a direct message to me, but I think it's actually for you. How do you manage the company's, wait, now we've got, hang on, we're gonna manage the company's cash flow projections. Let's save that one for later. The range of interest rates for consumers. With most buy now, pay later companies, the interest rate is usually 0. It can go up with a non-payment. So there's very little risk to it unless there's a default. There can be some, if there's a very, so let's say your soft check comes back with a fairly low score, there can be a smaller interest rate, or it can, some of them can be a little bit higher, but that can also be paid down because the payments can be made faster and then it can be paid off faster. Typically the charges come when a payment is late, or some small service fee. So very much like the credit card industry, it's the retailer and it's the retailer that gets charged the fee. The retailers obviously want to use this as a way for customers to pay for their goods. So they're charged the fee, not the consumer. But that said, that goes away if you're late on payments. There's a couple of things. Who pays the appliance return? Well, let's save the return questions because we do have that on. I'm going to write that down for this because we do have that.
I can answer the next question because it's actually pretty interesting.
Yeah, that is a good.
Just curious to know the default rate on this kind of non-prime consumer market. Also, given the impact of the pandemic on economic stability, do you see a rise in the trend? Interestingly enough, our default rate's actually pretty low, and I think it goes back to credit on our models, but it also is because it's a lease to own. We get, numerous payments before a customer might default, and so, in default terms, we're getting sometimes 80 to 90% of what we originally put out, and so our default rate is actually pretty low, and it's really interesting business because. Just like at the beginning of the pandemic, because we're in that waterfall situation from the prime lender like Affirm to us, when the prime lenders tighten up, which they all did in March and April last year because they were worried about the economic cycle, we get a better customer. And so we get a customer that might have gotten approved before the pandemic is now flowing to us, and they're just a much better paying customer, and we'll tighten up as well. So it's actually a very flexible business around economic stability or instability, and because the term's short. Our average term is about 7 months. It's a 12-month contract, but most people pay off early, and so we can cycle through the payments. It's not like a mortgage or a car loan that's 3 years or 4 years, and so we can tighten up and get rid of some of the bad debt pretty quickly, and then we're getting better customers coming in through the flow because they were turned down from the prime lenders. And we saw that at the beginning of the pandemic when you saw the Chase and Citi and everybody else put up these big reserves for defaults. They tightened up, and so we were seeing a much better customer, and the vintages that we had in March and April were our most profitable vintages we've ever had.
So that really does lead into our next topic, which is financial inclusion and credit effect. One question that came as also a direct message to me was, does Catapult hold the loan or do you sell it?
We hold the loan and we service it ourselves. This is, I think what's interesting about this business, because it is the non-prime consumer, we've gone through great lengths internally to work with the consumer to try to get them to ownership. And one of the things that we brag about is, just like Affirm, we don't charge late fees, and so we don't start racking up late fees just because they missed a payment. We try to communicate with them and say, okay, you missed a payment, how can we get you caught up, and work really closely with them, and I think it shows. And we do it through chat, we do it through text, we do it through email. We actually tested not calling consumers when they're late because, one, people don't pick up the phone anymore. So I think taking a soft approach to the consumer and say, hey, we want to work with you if we have to settle for a lower amount on their payment or whatever has worked. I mean, we're profitable. That's one of the I think the reasons why we went public or are going public, because there's not many SPACs that are de-SPACs that are that profitable. And so we're profitable, and it's because we've worked really closely with the consumer. It's clear, it's transparent, they know exactly what they're paying. We actually encourage them to pay off early, not because, not because we want them to necessarily, because a lot of loans, the longer they pay, the more money they make. We want them to get to ownership as quick as possible. And like, for example, in the first 90 days, they could pay it off and they're only paying 5%. And we want them to do that. We remind them of that all the time. And it's really important to work with this non-prime consumer because things happen, life happens, right? And as the statistics show that they're $400 away from a disaster, and we want to help them through that.
And so one of the things I think that I found really interesting about Catapult when I first learned of them and did the first briefing with Orlando was that the financial inclusion that's important to them and graduating these subprime lenders to kind of a higher tier where they would qualify for maybe the first time they didn't, maybe the second time they didn't, but the next time they might qualify for a loan with a firm. Tell us more about like the programs that you're doing to help these people kind of get past this point in their life to the next, yes.
Part of the agreement we had with a firm when we signed the waterfall agreement is, we'll take their declines, we'll approve these people, and then we're going to share the data with them on their repayment history. And if the customer paid well, I want to give them the best credit for their situation. And so we agreed to share the information with the firm so that maybe they can offer them a lower, a low interest loan or no interest loan because they've demonstrated good pay through. And so we really believe that, this financial inclusion that we're touting and we strive for is to really elevate this consumer so that they get better and better offers. And that's what we're trying to do. And we're clear. And I said, clarity and transparency is our mantra. I had a call with Max Levchin for an hour and a half. He drilled me about, how we treat our customer, and that's why he agreed to partner with us. But I think as we move along in the next few years, I'm going to look for other products because, this consumer needs help. They need that financial help to get the items that they need. And if we can provide other products to do that with, and work with them to improve their credit score, to improve their livelihood, we're going to be there for them.
So that was kind of, okay, let me see what other questions. Sold on the secondary market. Okay, I think that was already answered. Okay. Oh, what regulator determines the limits on fees and APRs?
You want me to answer it?
Sure.
Yeah,
The answer is none, but
well, we're regulated. We follow the state-by-state regulations, which have been around for decades, and we're pretty. I think we actually do better than what the regulations require. So, for example, we're allowed to charge the late fees. We don't. We're allowed to repo the item if the customer doesn't pay. We don't. So I think we're probably on the better side of some of the regulations. And then there's somebody asked about whether it's a lease or a loan.
Yeah,
I said
I
loan.
think just add just a little bit to that. The fees are somewhat regulated just by general consumer law. But there has been recently a lot of talk about regulation around the buy now, pay later industry. I would expect that to come, especially with the amount of regulation that's been discussed around app usage, fintech app usage in particular. I'm sure everybody here is familiar with what's happened recently with Robinhood and all of the trading apps. We're seeing it happen in cryptocurrency. I would definitely, with all of the new SEC appointments and OCC, I definitely think that regulation here is coming. I'm of the mind that those things are always actually a good thing for consumers, but right now, state by state and general consumer law is where it's covered.
Yeah,
And
yeah.
I do not see any of the companies taking advantage of that. And again, when critics call it payday loan type stuff, that's ridiculous to me. There's not one company that I see doing anything close to that in this industry.
Correct. Yeah, I think the one thing on the BNPLs, especially, I call them the 4 pays. So you split the payment over 4 different payments over 8 weeks. Is it a loan or not? And that's I think the question that hasn't been answered by the regulators. Obviously, we're doing the lease to own, so it's much different. But that's gonna, I think, from a regulatory perspective, that's where the rubber's going to meet the road with the BNPL, is if they determine that it's a loan, and then they're going to have different requirements and stuff.
Okay, so then if you're going to offer a good customer a no interest loan, how will you make money? I think that was answered, that the retailer pays the fee just like they would on a credit card purchase. You said the severity of the loss is 10 to 20%. Did you answer that?
Yeah, I did. I think
Okay.
I did. What is the probability of a consumer to default regardless of how much the recovery? I don't know if I have the probability. I mean, that's just the numbers that we've had seen in the history. It's just very low, and it's because our models keep getting better and better. So we obviously track that number and look really carefully at that number on almost a daily basis to make sure it doesn't get away from us. But our biggest issue online is fraud, and that's where we have to prevent the fraudsters from getting to us, because you can ship stuff pretty quickly now these days, and as long as we can control fraud, the rest is actually pretty easy. The consumers are pretty responsible.
So we have talked a little bit about returns, but I think that is something important to talk about. One, because a firm made that acquisition of Returnly, which I think signifies a pretty a trend. If they're going to get into the return business, and I think one of the quotes from the CEO was "Buyer's remorse is real." As people start to get back into shopping and spending, and there's maybe less certainty around government rescue and stimulus checks, but people have gotten into habits of spending. How important is being able to return an item, and how important has that been to your customers? I know you've talked a little bit about your lease to own policy and being able to return things at any given point. I think one other thing that's I like about your model is what you do with those returns, and maybe that helps to answer the question, who pays for that? Because
Sure.
That was in the chat.
We do. If somebody wants to send something back, we'll send them a shipping label. But what we like to do is during the first, whatever the retailer's return window is, we have them return it directly to the retailer, and most of our retailers give like a 30-day return policy. After 30 days, the customer can return the item at any time. They could be in the second month, and they can return it to us, and we'll send them a shipping label if it's a small item. If it's a big item, we'll send a truck to go get it. But then the beauty of it is we discharge the debt, so there's no debt, unlike maybe an installment loan or something else. If they're not happy with the item or they're not using it anymore, you're still stuck paying that loan. And so what we do with the returns is, depending on the time, has it been 6 months? Has it been 3 months? How good of the item? Less than 2% of our leases get returned, and we take about a third of them are donated. And so, we're looking to donate laptops and things like that when we get them, if they're in good working condition, to needy families. And then about a third of them are sold on eBay or wherever we can sell them. And then a third of them are just, they're just really not worth anything, and maybe we give them to the Goodwill. So it really depends on the age and functionality, and if it's in good shape or not. I mean, I've had 65-inch TVs returned, and they don't ship well when they come back, and they're usually broken by the time we get them back. So, but we don't hold the consumer responsible for that. So, again, it goes back to that clarity and transparency to say, look, if you want to return this for any reason, we don't even ask the reason. You just call us up and say, I want to return it. You might be 3 months in, you might be 6 months in, and we'll take the item back.
But for somebody who, maybe needs a computer for their kid for remote learning for a couple of months and can't afford to go to the Apple store and buy one, but they can get a Lenovo computer and use it for 3-4 months and then return it. The fact that they can do that, and, with the possibility of knowing that maybe that gets donated to, a low-income school somewhere is, I think that's a much better proposition than, being, sorry, we're in the middle of a massive storm and my front door just blew open. Welcome to Texas.
I'm glad I'm in New York, not in Texas.
And I have a big, massive, heavy door. Okay, somebody else just wrote, given the extensive use of AI and ML in the consumer market space and vast e-commerce players, how do you differentiate? Also, who are your competitors? I think that's for you, although I think I'm going to answer just from a general perspective. There are a lot of people offering this, and there doesn't seem to be a limit. I mean, everybody, there are definitely some major players in this space, kind of the big four, if you will, and then, add eBay and others to that. We're even seeing credit card companies now getting into this. Amex, MasterCard, Visa are offering ways to pay that aren't necessarily traditional credit card payments, offering, pay in 4, pay in 7, whatever it is. I don't think this is going anywhere. And I'll let Orlando offer or answer how they differentiate, because their model is vastly different from what these others do. The use of AI and ML, I think, is a different question, but very important. And I've actually been studying that a bit, because it is, used to make these really quick decisions, especially when we're lacking the ability lacking the decisioning from the big credit bureaus. So without using a credit score to determine that, where these companies are using things like rental history, job history, a lot of other decisioning process that doesn't include a credit score. Even, some things as much as like how long they've kept a cell phone number can be used to determine their credit worthiness to make these decisions. So AI and ML, I think, are used a little bit differently in that, given that question. But in terms of differentiate, I think Catapult is, I don't see many competitors on that space, but certainly from the others, there's quite a few of them, but some larger than others.
Yeah, nobody's really focused on the non-prime consumer for e-commerce. I mean, that's why we're excelling the way we are, is because this consumer has been passed over on e-commerce. If the consumer is maxed out on their credit card, but they need a refrigerator, they're not going to split a $600 refrigerator over 4 payments. It's just they can't afford that. So we give them that option to go longer and to pay it back. So we don't believe we really have any competitors. There's a few brick and mortar competitors that have been in this space for a while, some would argue that they're a competitor on e-commerce because they can buy the technology, they can build the technology, but building the technology and understanding this consumer and how they buy and how to work with them, things like no late fees and the clarity and transparency is something that they haven't learned yet. I think it's going to take them a while. And then to have the models, the fraud models. And I had an example. We had one of our competitors who was at a retailer, and they were side by side with us. And one of our investors went in and faked their information to see if they would get approved. Well, we turned them down because they faked their information. and my competitor approved them. So, you know, it was actually a big win for the investor because he said, okay, your model is actually better because I faked my information and they approved me and you didn't. So those are the differentiators that I think make us successful. And you have to be on your game when it comes to e-commerce, or you'll get your clock cleaned.
So somebody sent me a question asking who the big four are. I mean, there certainly are others, but Affirm, Klarna, Afterpay, and PayPal are kind of the big ones to be thought of. I'm going to actually put a link to the Forbes article that I wrote that is how Doug found me. I'm going to put that in. Oh, actually, I'm sending it as a direct chat, but I want to send it. Hang on. I'm going to not send it as a direct chat. And then there was a question for you. I think it's for you, but maybe it's in response to my answer about AI and ML heightens the need for fair lending analysis for your process of credit granting decision. But what have you done so far on this front is obviously a question for you, not me.
Yeah, no, we follow kind of all the lending guidelines, even though it's a lease, and it does fall under different regulatory perspectives. We still follow the fair credit lending rules. So, you know, there's no redlining, things like that. And we stick with that because, one, we just want to be fair to our consumers. And I think they're called fair credit lending rules for a reason. And so we want to be fair. And I think we go overboard on making sure that each customer is evaluated evenly and fairly and given the lease based on, you know, the information that we have. And, you know, my risk team is based from people who work for Citibank and Chase and a lot of the big banks. And we've done a really good job, I think, not only following, but going overboard on some of the fair credit lending. So I'm pretty comfortable with that.
Kind of on that same topic, I think there's a pretty big need in the industry for a pretty in-depth audit of whether AI and ML is sufficient for that, because we're seeing that as an industry in general, AI and ML is a very white, male-dominated industry, and like anything, even machines can learn bias.
That's true.
And I have actually been doing a bit of digging into this, and it's amazing how many people don't want to talk about it. Like companies that don't want to discuss the issue of diversity, lack of diversity in AI and ML.
Right.
So it's, but that is an issue. And so if people are relying too heavily on AI and ML to make these decisions and not heavily auditing it, that's a problem.
Agreed.
Now, see, even that's like just a heavy silent subject. I mean, I think we've answered all the questions. I think we've covered most of the topics. If anybody has any other questions, please put them in the chat. If not, does anybody want to talk about SPACs? Because I want to ask Orlando some questions, or actually maybe Doug wants to ask some questions.
And I'd love to hear about SPAC. As I mentioned before the call, as a financial advisor, I received newsletters, and a newsletter went out today just about SPACs. So it's definitely a topic of interest. So if you have something to share with us, I think the group would, at least I would be very interested in hearing. Thank you.
Sure. Now it's crazy, and not only was it fast and furious, I said it was like getting an MBA in 3 weeks. You know, you had to go fast, but it's been thrilling too to do it all on Zoom. Like literally, I'm taking a company public. Actually, I'm in New York, you know, for the first time with our leadership team together because we're all vaccinated. The guys who run the SPAC, I'm actually meeting them. They're standing outside my door right now. That's the first time I've ever met them. So it's kind of interesting that they executed their SPAC and then merging with us all on Zoom. So I hope I don't disappoint them tonight when we go have drinks. But it was thrilling because, we decided last summer, we got an inbound inquiry from a competitor. And so we hired an investment banker to shop the deal to see if it was any good. And the investment banker said, hey, have you thought about a SPAC? I'll be honest with you, I had to Google it because I wasn't quite sure what it was. And that was August of last year. And here we are de-SPACing now. So it was fast and furious. We learned about it. I mean, it was exciting because, one, they brought some expertise. So there's three guys that did the SPAC. They went public about a little less than 2 years ago, and they evaluated 800 companies and looked closely at about 100 companies before they made the decision to go with to buy us. And they did it because, one, we're profitable. We've got a really strong growth story versus some of the SPACs you see, electric cars, and they haven't even made a car yet. So I think our story is a little different than some of the other SPACs. There's no celebrities that have joined the SPAC, but we raised, they raised 250 million. We also went out to the market and raised the PIPE, which is public investment in a private investment in public enterprise. And it was interesting. It was a great story because we were out talking to big like Tiger Global and really big investment firms, and we actually got we were looking to raise 150 million, and we got 450 million in orders. I mean, so the excitement around not only SPACs, but I think the excitement around our business was there. So you have to go through some bells and whistles or hoops and leaps to get SEC approval. We got that last Friday, and now we're kind of good to go. And they've got to do the vote on the SPAC side, and then we'll literally on June 9th, the ticker symbol will change to KPLT, and hopefully I'll be there ringing the bell.
There was another question in the chat about your model, and this is actually an interesting question. Could you extend your offering to other higher value products like auto or mortgage? And that just reminded me too, just that we should return to the outlook in 20 to 24 months, which I think leads to stuff like auto and mortgages as well as travel. So what you want to answer that first?
We haven't gone that far. We could. We just have so much opportunity on the e-commerce durable goods side. I think we're focusing on that. But after we go public, and I'm looking for acquisition opportunities, I think buying a platform that does auto sounds really interesting to me, and I'm kind of an auto guy at heart, and from my background, back when I graduated from college. So I would love that. But right now, I don't think, even though we have some of the modeling on the credit risk side, we're doing a really good job on it. When you get into those bigger ticket items, it does change. And I would walk very carefully in it.
Yeah. So that kind of, that does bring me back to, as interesting as the SPAC stuff is, and it's definitely, to answer to what Doug said about, is it fad? What was the question? Is it fad or what?
It was
fad or trend?
Or trend, exactly.
First of all, what's the difference between a fad or a trend? I'm not really sure about that, but
that's a little longer.
Okay. Yeah, I mean, I think what we're seeing with just, the SEC kind of coming in and saying like, enough is enough with this, and kind of putting some reins on it has been a good thing, because anytime you see celebrities, just every celebrity has their own SPAC, and it kind of gave me like a little bit of PTSD of like the ICO, the initial coin offerings of 2017, that, all of a sudden every celebrity has one, and they became so meaningless and useless and actually valueless. And a lot of people got really burnt on them. So I was happy to see that it kind of cooled down. The problem with that is it did put a little bit of a damper on the ones that are good. There are some really good ones out there, like Catapult, like lottery.com, like SoFi, that, essentially this is just a reverse merger, but because the SPAC has become trendy, it kind of got into this like insanity of everybody now has a SPAC, every celebrity has a SPAC, every whatever, but it's definitely an interesting thing to watch. So for outlook into the next 12 to 24 months, we've talked a little bit about how people are going to shop. We've talked a little bit about, changes in purchases. Like I said, 30% of firms' purchases in 2020 were from Peloton. Obviously, that's not going to continue. People want to travel. That's changing. One of the things that we're seeing with a lot of these companies is how they're adjusting to people. The way that people want to shop is cards that they can take into retailers to purchase, even if a retailer doesn't necessarily offer a buy now, pay later option. They can take in a card to that retailer and still have that as a way to still buy something on that, kind of payment option. I don't see it slowing down. We're definitely seeing, the valuations of these companies went kind of skyrocketed. And like I said, global spending by 2025 is expected to be almost $350 billion. The industry is hot. It's going to continue to be hot. I don't see that really changing. I think that these companies continue to reinvent the model to react to what consumers need, whether that means cards that you can carry into a retailer, additional ways to shop online, other offerings that can be tailored to various forms of shopping. Like I said, I think nobody's been able to travel over the last year. And so buy now, pay later for travel packages and things like that hasn't even really been an option, but it's certainly doable. Obviously a lease to own on a travel package is a harder thing to do, but not necessarily for future travel. It might be hard to do for a plane trip I want to take next week, but it's not necessarily hard to do for something I want to do 8 months from now. It's more. So I think that the industry is going to need to pivot and continue to reinvent itself to answer to a new reality post-pandemic. But every industry has to do that, and I think that the outlook on the industry is strong. And I think even a big indicator of that is that we're seeing that like I said earlier, MasterCard and Amex and Visa are following suit. If they weren't, somewhat threatened by it, they wouldn't be joining the party.
And if you saw the security lines at Austin Bergstrom Airport yesterday morning, travel's back.
Travel is back.
Out the door. I couldn't believe it.
Yep.
Thank God I have clear.
I know. Yeah, it's a lifesaver. Well, speaking of SPAC, I know those people are waiting for you. And just since I have personally had drinks with you, they won't be disappointed. Go meet them, unless anybody else has any questions. Oh, let's see. While general interest rates are not a factor impacting repayment, how does the predication of higher interest rates, the cost of money, impact thinking about growth and credit quality?
We've done some modeling around that. We do have a lot of flexibility around we have a loan to loan out money on the leases. So, but we have some caps on that, so we're not that worried about it. And again, if it causes a slowdown in the recession because interest rates go up, we tend to benefit from that because that prime consumer can't get credit. So we're not worried about it. We've modeled it. We're keeping an eye on it. But the cost of money for us at this point doesn't really hurt. As a matter of fact, we were talking today about we can fund this business through our own cash flow, and we don't have to lend money. So that's always an option too. It's just not as efficient. So we're modeled it. We're keeping an eye on it, but right now we're not worried about it.
I think we've answered all the questions, and I think unless anybody.
That'd be great. I got to go out and meet my SPAC guys.
Well, I won't.
Sponsors.
for everyone on this call, I'm sure I speak in unison. Thank you so much, Mel. Thank you so much, Orlando, for participating, for Mel, for answering my call when writing to you out of the blue in regards to
My
your
pleasure.
Forbes article. And of course, for bringing on board Orlando to make this presentation. Orlando, I assume we're all going to get an autographed photograph of you ringing the bell for all
Absolutely.
participants on this call.
I can't wait. You know, I hear it's a button on the NASDAQ. It's not a bell. So.
Oh, it's not a bell. It's NASDAQ. Okay, just a button.
But I'd say ring the bell. I'm ringing the bell.
Yeah, it's still the bell.
No, this is fantastic. I really appreciate you speaking here for the FANG, for the Special Interest Group Banking. Next month, we have a presenter, James Francis, who's the CEO for Paradigm Asset Management, based out of New York. So I hope everyone in this call will join us next month to hear James Francis speak. And, thank you again. Everyone have a great rest of your evening and a safe rest of the month, and enjoy hopefully some good weather and no one else's doors blows open. Yeah. Thank you.
Thank you so much for having us.
Thank you.
And thank you everyone for joining.
Thank you.